Today is January 17th, 2024, and I'm back with another edition of the Wednesday Live Show, and lots going on. We're headed right into the thick of earnings season. There's all kinds of interesting stuff going on in the market and the world, and lots to talk about, so I'll try and keep it brief. I thought maybe today we'd look around at some various sectors and the overall market, and I think everybody kind of has this expectation that the market itself is due for a pullback. And oh, there's some breaking news now. There's always 10 o'clock is a good time for we'll see, it's business inventory. So we'll see how that affects the market. But anyway, so we've been talking about this for a while now. The big thing here is that the market kind of expects that the Fed is going to start lowering interest rates in March, right? And then I don't know what's even priced in right now. So it seems like going into the year, it was like the market at one point was pricing in like 7 rate cuts, which seems sort of ridiculous. But the thing is that and keep in mind we're in an election year, but the thing about it is that the economic numbers have been pretty good, right? Like most of the economic numbers coming out have been fairly reasonable, and so everybody now is beginning to question why the Fed is just going to start lowering rates and beginning to second guess that. And so, at this point, I think less and less rate hikes are going to start getting priced in. And so, I wanted to start off by looking at a weekly chart of the S&P here. Well, let's see. Let's take a little bit. There we go. This is the chart I was looking for. So there's the previous all-time high, and we came up and just barely almost hit it, right? And so you can see on the weekly chart, we're on like week 5 of this little bitty consolidation up here. And so it's going to be really interesting to see, what happens from here, whether we get a little poke above this nominal all-time high, or whether we're going to fade down a little bit and maybe test this trend line, right? But I think that I saw something yesterday about valuations, and valuations got really stretched. So that little run from November to the end of the year was pretty outrageous, quite frankly. And so, like I mentioned last week, I think a lot of it had to do with a short squeeze, and a lot of it had to do with positioning and institutions, wanting to get the market higher into the end of the year. And so I think they just jammed it up. But now we're in earnings season, and so it seems like the main driver right now is what the Fed's going to do, and all these economic numbers that keep coming out. Basically everyone's saying, well, why would the Fed possibly want to start lowering rates now when everything seems to be humming along fine? And then, of course, if you actually dig into the numbers, then there's always something. There's always something about the numbers that you have to look at, and they can be a little bit misleading too. So that's the other thing. But anyway, so the S&P is right up against the all-time high. It would be interesting. It would be interesting if they managed to. It still seems like there's a bid under it though. Like we're getting these little sort of dips in that, and then they get bought. Like you can look at just even the past few days here. Well, and going into the new year, right? We got this little dip, and boy, they just bought it right up. That was just barely a dip. So lots of, and of course, it did make another nominal little high here from back in December. So I wouldn't put it past the market to go either way. So, but right now, we have the high from a few days back, and we have the low from, I guess that was probably a week ago, a couple weeks ago there. And so we're just kind of like you saw on the weekly chart, just in this big consolidation area, and it's very difficult to know which way it goes. But let me let me zoom out a little bit here. Yeah. In the bigger scheme of things, it seems to me that the path of least resistance would be a pullback. Probably there's the 50-day moving average. There's a big horizontal support here at about 4,600. That was sort of, this run up from these lows is just, you can see the breakaway gaps here and the continuations, and then this last little mid-December rally, I think, was was the last sort of hurrah. And at this point, I think it's gonna take a lot for the market to just turn around and continue up. And keep in mind, we talked about this a bunch of times. In order for the market to make an actual inflation-adjusted new high, right? Not just a nominal new high, 48.19, right? The market really would need to go to like 5,300, which is a long way up. So interestingly enough, I always look at like the year-end targets for the big institutions when they try and predict a year ahead of time, where the market's going to end, and they're not as aggressive as they had been in previous years, which makes a lot of sense considering the fact that S&P was up 24%. More interesting, I should say, what's going on right now is that tech, some tech is acting kind of weak here. There's the Nasdaq 100, right? And you can see, it had the same sort of dip kind of going into the new year, which got back up, made a lower high, but look at what it's doing today. And I looked at ARK before the show came on here. This is really kind of the the proxy for risk and growth that we always look at. And look at this sell-off. I don't know if this particularly leads the market, but it's just a really good proxy for how much risk, speculative risk, I should say, investors are willing to take in the type of stocks that ARK generally holds. And so that one had this huge run up along with everything else, same sort of pattern, and that's a pretty big crack right there. So, I mean, it went from 35 to 55, and now it's at 45. And so that's a pretty big red flag there. Let's look at Apple real quick. Apple's had a pretty rough go of it lately after the huge run up that it had along with the overall market, and it's sitting right smack. Well, I should say, yeah, sitting right smack on the 200-day moving average here, and it's going to be interesting to see how this plays out. So this is obviously the most widely held, widely followed stock, and of course, the thing about it is, this is a good example of how the 200-day moving average is just it's just kind of a level, and you never worry about it to the tick, or if it pokes below it here, comes back above it like it did here. So I mean, it's finding some support here. Microsoft surpassed Apple in market cap the other day, which is kind of interesting. But we got this little gap down this morning from the economic numbers. Before I forget, a couple other things. So China is like, let me go to a weekly chart here. This is large cap Chinese stocks, right? So China's having kind of back in the old days, over all these years here. As a matter of fact, I remember this well. In 2015 here, this big sell-off in 2015 and 2016 caused a lot of turmoil in the global markets, right? And so it was, sell-off in China. If China's economy slows down, then that was a big deal. Look at this. So you can see when this ETF started. But the interesting thing to note here is that as we speak here, I mean, look at this. And I guess this is probably the best proxy for what the Chinese market's doing, but it's lost over half of its value here, which is something that should be concerning. And especially if you look back, I mean, you go back for 13, 14 years. Um, so, I mean, the point here is that somewhere along the way, if someone invested in China through this ETF thinking, hey, this is, and over the years, of course, everybody has thought, well, China's is the up and coming economy and all that type of stuff. And so this is really a bust. I mean, could you imagine being in this ETF through all this without taking any profits? I mean, there's a lot of charts out there. Um, Alibaba is this is probably another good proxy for China, right? Alibaba, the Amazon of China. I remember all the hype surrounding the IPO, and this I believe is a very widely held stock, and it's incredible to me to see that this thing is, I mean, it's basically back at the IPO price, right? Just absolutely incredible. And so, I'm sure there was tons of money made in this stock along the way, but this is just a great example. And of course, this is a weekly chart, right? So this is a great example of why you got to take some profits in stuff at certain times. You can't, if you just buy and hold. There's a lot of stocks out there that have these type of patterns where if you just buy and hold, at one point you had a gargantuan gain, and then at some point, the whole gain was gone. Whether it comes back or not is based on the individual stock. But this is just really an eye opener, right? I mean, we're going back almost 10 years here. Just a little less than 10 years. It IPO'd in 2014, obviously. And so, yeah, I mean, it's just a mess. And so the fact that China's having all these problems, and I think it was like Korea was down like a couple of percent, 2 or 3% last night. So there's some cracks starting to show up. Here's something else to keep an eye on: the TLT, right? So TLT had the huge run up. There's a extremely high correlation between obviously interest rates and what the market does. And so you can see that this TLT had the same big run up from November into the end of the year, just like you see on so many charts out there. And it's it's already kind of rolled over here and given some back. So there's the 200 and the 50 day. And so that means interest rates are going up a little bit. So it's gonna be a tricky year, I think. And the other thing is that here in seasonally speaking, I think everybody kind of expects a little bit of weakness here, and it would make sense. What didn't make that much sense was the huge run up that we had at the end of the year. I think that was it was just it was overdone, right? And so sometimes the market does that, but it does what it does, but then you got to pay the piper. And so, we've been looking at this chart of the IWM Russell 2000, right? Whoops. We looked at this last week and previous weeks, and we talked about the idea of how it broke out of this range and was looking like it was going to come back in it. And typically in the past, it's made a move from the top to the bottom of the range. And this is a little bit different, but the thing to note here, let me zoom back out, is what this reminds me of, what's happening right here reminds me of this, right? Back in 2021, we were talking about this exact same thing, how it was just range bound, and then there was this breakout, right? That I guess you call that a bull trap or a false breakout or whatever. And after having consolidated for literally almost an entire year, and then break out like that, everybody would have thought that breakout would get some, well, it did get some pretty decent follow through for a period of time, but it was kind of a parabolic move, kind of like what we've seen over here, right? Actually, the current move since November to the end of the year was more parabolic than where this move started from. But you can see how it just gave it all back, and that's crazy stuff. And so when I sit back in my chair and I look at this pattern from back here, these highs, and I look at this, I mean, they look almost identical. So it's going to be interesting to see if this thing is, it looks to me like at least, and it may consolidate some. I mean, it's probably already oversold, but it looks to me like at least it's going to come sort of like it did back here, at least about halfway back into the big range. So that's something to be aware of. These kind of spike highs and pullbacks, spike high, you get sort of almost a parabolic move and then a spike high, and it starts moving in the other direction. Um, there's typically some inertia involved, so this is another red flag, right? Um, let's see. There was a couple other things I wanted to look at. So we looked at the Russell. Let me go back to the S&P here on the daily chart. You got the big cup and handle, and so quite frankly, everything over the past few weeks here, going back to mid-December, is just kind of a consolidation area. It's a consolidation area, and the market's consolidating this huge move from November, and then something is going to, probably something having to do with the next Fed meeting. Well, that's not till March, right? So there's a long way to the Fed. I mean, they talk a game, but what they actually do in March, I think, is going to determine which way this thing really breaks. So, and like I said, the main thing to keep an eye on, or to keep in mind here is, and this is almost crazy, is that in theory, and this, you can do this on the CPI calculator, like, the amount of purchasing power that the S&P had back here in at the peak, at the very end, December of 2021. Here we are 2 years later. If you take that 4818, plug it into the CPI calculator to see what you'd need today to have the same purchasing power, it's up right around 5,300. So that's always a consideration, because the idea of investing in stocks is to keep up with inflation, preserve and actually grow purchasing power, right? I mean, to preserve purchasing power, um, you buy gold. I saw something the other day. Yeah, look at gold. Look at gold here. Let's go to a monthly chart just for the fun of it. Wow, look at this. Hadn't looked at this in a while, so look at this. The monthly chart of gold starts in 1970. Interestingly enough, I believe, it looks like 1970, but 1971 is when Nixon closed the gold window, right? And that's when everything changed. And so here we are. I saw a post somewhere that said something to the effect of, since 1971 up until now, that gold has, like, the price of gold has compounded at like, 7 point, it was like 7.8%, or almost 8%. It was a 7 something, like 7.5, 7.8% for the last 52 years, or something crazy like that, since, I guess it would have been since 1971 when the gold window was closed. So that's crazy to think about, because over the years, gold has been sort of it's been very controversial, I should say. Most institutions and all that obviously don't. I mean, at different times over this period of time, obviously 50 something years, there's been plenty of institutions that have been bullish on gold, or I suppose recommended it. But overall, they tend to pan it, and they tend to compare it to stocks and say that that it's dead money, it doesn't pay dividends, and this and that. And so there's a whole debate about that. But the fact of the matter is, if it has appreciated, average annual compound rate of over 7.5% for 50 years, that's notable anyway. So my point here was that this is probably preserved as we speak here. Now down at these lows here, whether it preserved purchasing power or not is debatable, but it's kind of interesting. So look at a weekly chart here. Um, yeah, I mean these are long time frames. This is very similar to kind of like what the market has done recently with the big cup and handle. I mean, it's a similar sort of cup and handle pattern, I suppose you could say. Um, and there was a long period of time here where it was just basically dead money. But when it emerges from a pattern like this, let me go back to that monthly chart. Back to this monthly chart here. Um, yeah, here's that big giant sort of cup. And then I suppose you could, it did make another, it made a little high here. And I suppose this period here would be considered the handle. And it's kind of interesting on this monthly chart, those little pokes that you're seeing up here. But anyway, the price of gold is right up near an all-time high. So I guess the stock market overall over that period of time is probably compounded at, they say, 10% average annual rate or something. So gold's held in there. It was many years where it hadn't, and people like to bash it. But anyway, let's go back to the weekly charts here, and let's look at back at the tech stocks. That's what I want to look at, was these tech stocks here, because this has yet another almost perfect cup and handle pattern. And I don't remember the exact rules, and I don't think in technical analysis exact rules matter that much, because people get too hung up on and I've said this in the past, I try and draw my trend lines, and I love it when they're perfect and they fit exactly to the pixel in that. But just like anything, moving averages, trend lines, patterns like this cup and handle here, you just can't apply extremely strict rules to them. I know some people do, but whether my point here is, like, to me, this is a valid cup and handle regardless of the fact that the top of the cup is higher than the previous high here. And this, it's almost more perfect. So I've never been a big fan of like measuring. I know in a lot of these patterns, there's hardcore technical analysts will measure like what the objective is from a breakout of the pattern. And so my guess is the objective on this would be quite a bit higher. But the funny thing is that, like I just mentioned, we need the market itself in order to make. Now here's the thing, the technology, or the Qs, the Nasdaq looks kind of like this, but I just picked technology because that's the sector that everyone seems to be focused on. And so the crazy thing is that, and I haven't plugged this into the CPI calculator, but it's the same sort of concept I was just talking about. So if you had $175, at the beginning of 2022, how much money do you need for the same purchasing power now? And maybe it's 200, right? And so the technology sector is on its way to actually making a new all-time inflation adjusted high, which is interesting to note. And so the other thing, real quick, let's look at the oil sector. I know going into the year, a lot of a lot of institutions, money managers, talking heads on CNBC, they like to, take a sector that's maybe sort of underloved or whatever, and they like to, say, well, we think that energy is a place to look at for the new year because it didn't really do all that great. I mean, you can look at this going into while everything else was rallying, all the indexes and the tech stocks and individual stocks, while everything else was rallying, into the end of the year last year, energy, and this is my let's look at XLE just to get a perspective. XLE is the energy spider, and XOP I think is probably a little bit. They look very similar, but this is a little bit broader of an ETF. And it's looking a little bit rough here, right? I mean, you can go all the way back to, I mean, it's had a lot of sort of characteristics where it's channeling almost like the Russell does, but you can go all the way back here and it's definitely got its own sort of thing. And so coming into the new year, I think look at this. I think there was maybe a lot of people that thought energy was going to be the place to be, and it still could be, right? I mean, we're just a few weeks into the year, quite frankly. We're on like the 12th trading day of the year, or something crazy like that, because with the holiday, with the 3-day weekends and all that, we just had a 3-day weekend, so my days are all mixed up as it is. So anyway, energy's something to keep an eye on. Um, Real quick before I wrap this up, I have this chart in my thing. This is the 1 year. This is the short-term yield here, which is kind of interesting. So I know last year a lot of people thought that since interest rates went up so much, right? Since interest rates went up so much, a lot of people thought, well, hey, I'll just sit on the sidelines and and collect like short term. So anyways, this is kind of, quite frankly, look at this period here though. This is just an amazing chart. A lot of the problems that we have as far as, everybody being in debt, every city, county, state, the federal government, as far as all the inflation, all that is the result of this, right? The result of them sort of artificially holding interest rates at zero for all this period of time and inflating the money supply. And so this is just an amazing chart. And then, of course, you can see, when the Fed embarked on their interest rate hikes, you can see the result of that. And I think I've said this before. I read somewhere that there's never been a period where the Fed embarked on an interest rate hiking cycle that they didn't break something, right? So that's where we are now. Anyway, so that's that. Headed into the thick of earnings season here. It's going to be interesting to see how things play out. So far, like I said, we're in a big 100-point consolidation range here for quite some time, going on a month now. And so we have, there's a high and a low. I won't bother to draw it on the chart, and we're basically stuck in the middle. So we're just going to have to see, which way this thing pokes out and breaks out of this range. And it's kind of like the market's looking for a little bit of a catalyst here. So usually the opposite of what makes sense happens. So I think the main catalyst now is just is going to be the Fed, and we got to wait until March to find out there. So anyway, thanks for tuning in. I'll see you back same